Jamie
Yes,
Dimon,
indeed.
America's top banker. He's sounding the alarm on our growing national debt. Ashley, what exactly is Dimon? He's issuing a dire warning. What's it about?
A dire diamond warning, yes. He calls it the most predictable crisis in history. In fact, former House Speaker Paul Ryan said that. He just agreed. But he also says that Washington is facing a market rebellion because of the tab it's racking up. While Bank of America's CEO Brian Moynihan believes it's time to stop admiring the problem and instead do something about it. Well said. Public debt currently exceeds $34 trillion, going up as we speak. Debt to GDP ratio sitting around 120%. Everyone agrees it's not sustainable. Democrats and Republicans both to blame, but how much of a threat does it really represent?
Jamie Dimon, chairman and CEO of J.P. Morgan Chase, warns of an imminent financial crisis that could directly impact your daily life. This crisis is linked to one problem: America's rising national debt. In this video, I'll explain why America's rising debt profile could be a bad news for the average citizen. I will also analyze the concerns of Jamie Dimon. But first things first, let's understand why America borrows money. Where does she borrow the money from? And why is it a problem now? Your understanding of these issues is crucial. Why does America borrow money? Remember when you ever took out a loan or used a credit card? It's because you either had no money or didn't have enough to pay for stuff. The same applies to the US. The government needs money to fund many expenses, and when they don't have enough from taxes and other revenue sources, they take loans. In 2023, the government spent $6.13 trillion. Compare that with the total revenue of $4.44 trillion, and you can see a deficit. The government borrows money to cover these deficits. Emergencies. Emergencies happen. It could be a burst pipe at home or a broken down vehicle. On the national scale, these emergencies could be economic depression, natural disasters, or unexpected geopolitical events. Just as you may use your credit card, the government borrows money to cover unforeseen events without disrupting essential services. Sometimes you may take a loan to buy a house or a car. America does the same, but on a larger scale. Building highways, bridges, and other infrastructure requires substantial capital outlay. The government can borrow money to fund these projects. Education. Education is another expenditure that makes people take loans. Likewise, the American government can take loans to invest in national human capital. Student loans, research grants, and educational programs are a few examples. Entrepreneurship support. Starting a business usually demands an initial financial investment. America is no different. The government may also borrow to promote entrepreneurship and innovation. Such investments can create jobs, increase productivity, and accelerate economic growth. Technology, defense, and international relations. America also borrows to secure its people and preserve its heritage. The government doesn't intend to be left behind in defense, technology, or global power. Loans can be used to take care of the expenses associated with these endeavors. Social programs. Don't forget the future. America may borrow money to fund programs like Social Security and Medicare. These programs ensure that the current and future generations have a safety net. You might ask, why doesn't the government just print money to fund its expenses? That would lead to inflation, a situation where there will be so much money in supply, causing a drop in the value of money. Consequently, there will be a rise in the prices of goods and services. Where does the government borrow money from? The American government borrows money from several lenders, both domestic and foreign. Domestically, the government issues securities like treasury bills and bonds, which individuals, companies, banks, and other financial institutions buy. Such securities are loans to the government, where investors lend money, and the government pays it back with interest over a specified time frame. The U.S. government also borrows money from foreign sources, such as foreign governments, central banks, and international investors. International institutions like the International Monetary Fund and the World Bank can provide loans to the U.S. during an economic crisis or specific development projects. So you can see that borrowing money isn't necessarily a bad idea. But when does it become a problem? When national debt becomes a problem. Borrowing shouldn't exceed the debt ceiling, the maximum amount the government can borrow to meet its obligations. Some indicators can help you decide when borrowing is no longer healthy. High debt to GDP ratio. The debt to GDP ratio is a significant indicator. A country's debt exceeding the GDP is like having a credit card balance that's more than your annual income. This ratio shows the capacity of the country to create enough economic activity to pay off its debts. If the debt rises faster than the economy, it may hamper the country's financial well-being. High cost of debt servicing. Another warning sign is the cost of servicing the debt. When debt payments take up a considerable chunk of the government's budget, it's like using most of your income to pay credit card interest. This leaves little money for investing in other areas, such as infrastructure and welfare. Debt becomes a problem when it grows to the point that it endangers economic stability, limits the government's ability to address national challenges, and creates an unsustainable burden on the present and future generations. But when you recognize the warning signs, you stand a good chance of preventing the problem from becoming a crisis. This knowledge empowers you to stay informed and prepared. This brings me to Jamie Dimon's warning. Jamie Dimon's warning. Why a financial crisis is imminent. 1. The current debt profile of the United States is at an all-time high.
U.S. national debt now hovering around $34.2 trillion as of February 2nd.
The U.S. national debt now stands at $34 trillion. This is about 123% of the country's GDP. To put it in perspective, the U.S. debt to GDP ratio was less than half what it is today 2 decades ago. However, it remains below the average of 128%. According to a World Bank study, countries whose debt to GDP ratios exceed 77% for prolonged periods experience significant slowdowns in economic growth. Interestingly, every percentage point of debt above this level costs countries 0.017 percentage points in economic growth. Since the first quarter of 2009, the U.S. debt to GDP ratio has been over 77%. To put these figures into perspective, the U.S. highest debt to GDP ratio was previously 106% at the end of World War II in 1946. Debt levels gradually fell before hovering between 31% and 40% in the 1970s, eventually dipping to the lowest ever ratio of 23% in 1974. Since 1980, debt to GDP ratios have risen steadily until 2007, when they jumped sharply following the subprime housing crisis and the subsequent financial meltdown. Ratios then went even higher during the COVID-19 pandemic to reach new highs and have only marginally come down since then. High debt to GDP ratios could be a key indicator of increased default risk for a country. Country defaults can trigger financial repercussions globally. 2. Imminent market rebellion. The stock market needs stability and investor confidence to flourish. Investors need to be sure that their money is safe. However, the situation is slightly different when people are unsure about the future, for instance, when there's a looming debt crisis.
But I think that the confidence is dissipating in terms of the economic impact of higher interest rates.
This is already a concern because, as of July 2023, CNBC had noted that investor confidence was dissipating due to the economic impact of high interest rates. If the U.S. debt continues to rise, it could only get worse. If investors start losing confidence in the fiscal market, they may withdraw their money from the capital market even quicker than you can say, sell, sell, sell. Such may result in a chain reaction of panic selling that can cause stock prices to plunge and lead to market turmoil. Thus, bond markets can also experience a rebellion under these circumstances. If investors begin to demand more return for buying government bonds, this will raise borrowing costs, making the debt situation even worse. Elevated national debt levels can cause a market revolt, scare investors away, cause debt servicing costs to soar, and send the economy into a tailspin. It's like playing with a stack of money blocks. It's a risky game, and any miscalculation may lead to the whole thing falling. 3. Interest rate sectors to be hit hard and cause a bankruptcy coup. Now, this is where it affects the average American citizen. Interest rate sectors, such as housing, cars, and education, will be affected.
The average interest rate on a credit card back in November of 2021 was 16.4%. That in and of itself is high. But as of this month, you see it right there. The average credit card interest rate's currently nearly 24.5%.
According to CBS News, Americans are already feeling the pressure from the hike in federal interest rates. Credit card interest rates were already as high as 16.4% in November 2021. As of September 2023, the average interest rate on a credit card was 24.45%. Also, within the same time frame, mortgage rates had risen by more than 100% from 3% to 7% within the same time frame. Since high national debt scares off investors, the government still has to find a way to sell bonds. So, to attract investors, the government must offer bonds with higher yields. Consequently, this will lead to a hike in interest rates. High interest rates can lead to a bankruptcy coup by increasing the financial pressure on individuals, households, and businesses. First, a high interest rate makes the debt of those who borrow to finance purchases such as homes, cars, or education more expensive. The more expensive the borrowing gets, the more you must pay to keep up with your debts. This puts a lot of pressure on household finances, making it extremely hard for individuals to meet their financial obligations. So, some of them will have to borrow more or resort to credit cards to cover their expenditures, creating a vicious cycle of increasing debts. Then, companies have to face the higher costs of obtaining credit for operations or expansion through loans. Higher interest rates affect the cost of servicing debt and decrease the money allocated to growth, innovation, or recruitment investments. It could be difficult for micro-sized enterprises to bear such additional costs, making them face liquidity problems or bankruptcy. Consequently, high interest rates also influence consumer behavior. With the cost of credit increasing, consumers may reduce their discretionary spending. This decline in consumer spending thus causes a domino effect, leading to worse performance for businesses and eventually possible layoffs or closures, especially for those companies already struggling with minimal margins. 4. Reduced public spending.
Interest expense for the U.S. federal budget in fiscal year 2019 was $885 billion before the massive federal spending to cushion the economy from the worst of the pandemic. Interest expense as of Q1 2023 was running at an annual rate of $1.2 trillion.
According to the video, interest costs grew from $885 billion in 2019 to $1.2 trillion in the first quarter of 2023. As the national debt increases, the government needs to set aside more budgetary allocations for debt servicing, thus depriving funding for public services, infrastructure projects, and social programs. Multiple mechanisms demonstrate how higher national debt could translate into lower public spending, affecting different economic sectors. Budget constraints. The high debt can overwhelm the government's budget, resulting in insufficient funds for new programs or the maintenance of existing ones. When a sizable proportion of government revenues has been allocated to servicing debt, policymakers are confronted with difficult choices about the distribution of remaining resources. This may trigger budget cuts, reduction in public services provision, or project delays in infrastructure, negatively impacting economic growth and social welfare. Reduced investment. As mentioned earlier, the government usually depends on borrowing to fund long-term investments in infrastructure, education, healthcare, and other key sectors. However, too much debt can make it difficult for the government to finance such investments. Thus, governments might lower or delay infrastructure projects, educational programs, and other social investments that have long-term impacts on economic development. Crowding out effect. Suppose governments compete with the private sector for the available funds. In that case, the high national debt can crowd out private investment and therefore cause a reduction in overall economic growth. As the government deficits increase, an increasing part of the available capital is absorbed by the government, thus leaving fewer resources for businesses to invest in expansion, research, and technological development. It can discourage productivity growth and reduce job creation, tightening government revenues and worsening debt. Downward pressure on social programs. The rising public debt may reduce social and welfare spending as the government strives to cut costs to control the debt levels. Programs like medical care, education, social security, and welfare might undergo budget cuts or reforms to reduce expenditures. This could be felt the most for those vulnerable groups dependent on these programs for their basic needs and support. This might further aggravate inequality and social disparities. For example, in 2023, America spent $659 billion in interest costs, more than on medical aid and income security programs. Potential for fiscal crisis. In the worst-case scenario, the high national debt can lead to fiscal crisis and a situation where a government cannot meet its financial obligations and provide for its people. Fiscal crises like austerity measures, increased taxes, or debt default cause economic imbalances and reduce public trust. A fiscal crisis may also lead to capital outflow and a decline in the GDP, further feeding the falling revenues and mounting debt cycle. Ripple effect on the global economy. The high national debt of the U.S. has a great impact on the global economy. Beyond the U.S. shores, it can also cause bankruptcy queues elsewhere. Here's how. Economic stability. The signs of any fiscal imbalance in the United States can have a strong effect on global markets, potentially triggering market volatility and uncertainty that spreads to other markets. These instabilities can dissuade investors, disrupt trade, and impede economic growth worldwide.
So if we as consumers and businesses are packing it in, that means that we're going to be importing less goods and services from the rest of the world, which would be especially bad to major global economies such as Germany or China, for example, that really rely on trade.
For instance, according to an analyst on CBS News, if the U.S. economy stalls, consumers and businesses would import fewer goods and services from other countries, negatively impacting the global economy. Financial system. The dollar is the dominant currency in the global financial system. It's the main reserve currency and the major exchange vehicle for international trade and finance. A threat to the stability of the US dollar could also be a problem for the global economy. For example, a sovereign debt crisis or a downgrade in credit ratings could negatively affect the whole economy. The possible loss of confidence in the US dollar as a safe haven asset would likely incur greater fluctuations in currency markets and probably cause the instability of the global financial system. So it's not just Americans that should be worried. People in different countries should also be worried, because many businesses could shut down, people could lose their jobs, and homes even become bankrupt. America's high national debt seriously affects the local and global economies. The consequences could be devastating, driving many businesses and individuals into financial distress and can extend to other countries. Everyone hopes the government will find a way out of this for the common good before it spirals out of control. I'd love to know your thoughts in the comments. Don't forget to subscribe to my channel so you will always be updated in the financial world. See you on the next one.